Hey everybody, good weekend. Here's your market minute for Sunday, the 10th of September. I tell you what, folks, the S&P is at a very critical tipping point. So I'd say within a week or two, we are going to see whether this energy is going to end up unfurling to the upside or whether we have just started the reversal process to the downside. Now, rule number one of fractal energy trading states that larger time frames dominate the trend. So we have this huge monthly swing to the upside. I call it a monthly swing and not necessarily a monthly uptrend. A monthly uptrend would imply that we have some type of a higher low and a higher high. So I don't think we can count the March low as a higher low. I think this is one just big swing that's come off of a big consolidation pattern, which was the back half of 2022. And really the first third of 2023. So from that spawned the next swing to the upside. We still don't know if we're working on that higher low, but rule number one states that larger time frames dominate. So that is a very strong endorsement to the upside. Now, as we go down to the weekly chart, what we have so far is basically an uptrend on the weekly chart. We've been in a weekly uptrend for quite some time now, really since the October lows. All of these are higher highs and higher lows along the way with a great big swing to the upside. Higher low so far, but the question mark here is this is a lower high. So how does that play into it? Well, range expansion goes to range contraction, which is part of rule number 4. So this is definitely a contraction move here, and it may just end up being this big pennant. But let's pull in rule number 2, which states that reversals start from the inside out. If we go down to the daily chart over here, so on the right-hand side is the daily chart, this is where we could see the very first clues to a potential reversal back to the downside. Now to do that, I'm going to zoom way in on these candles. And last week we talked about, well, actually, I think this is like 2 weeks ago, I talked about a Darvas box based on this box here with the upper candle, which was a reversal candle showing resistance. And then we had this lower candle here showing support. That was another reversal candle that showed this 100-point box. Now, based on the JOLTS report, 2 weeks ago, we broke out to the upside, but now we've gone right back down into that box again. So what kind of Darvas box can we set up for this week? And to me, I think we may have to go in really close on this one. Now, a couple of things to look at here. So first of all, the fibs. And this may not play out exactly because this is the SPX and not the ES, but let's give it a shot. So we've had the price come down to the 61.8% retracement. So from this swing, which started back here, this is the latest swing, we've already eaten up 61% of that swing. Now, if we see the price go down below that, it is statistically much more likely to go fill in the triangle and come down and at least retest 43.50, if not cut through there. Now, if that were to happen, if that were to undercut 43.50, that makes all kinds of things happen. So not only do we have a downtrend on the daily chart, but also this starts the reversal process on the weekly chart, because that would be a lower high, lower low combination on the weekly chart. That would be a full change in polarity to the downside. That would be pretty bearish and probably would target 4,300 to 4,200 at least on the initial swing down, because this whole formation would turn into a bull trap. So obviously we can't wait for the price to go all the way down to 43.50 before we were able to take any action and get bearish. So what I'm proposing here, let's go ahead and mark some of this stuff off of here. Let's zoom in as far as we can into the very smallest Darvas box that we can build. And that's going to be this one right here. So if we kind of zoom in on this area and draw a box right here, this is what we're going to find. So we're bounded by about the 50-day moving average to the upside, which is just about 44.75 or so, 44.80. and to the downside, which is going to be about 44.30. So 44.30 up to maybe 44, say 75 or so is the current range of bucks. And the reason why, again, I'm using these is because there was a shorter term reversal, which started down here. That represents support. And then Friday, we had sort of a little bit of a hanging man here. We're technically more of a shooting star at this point, where we had the price closing much lower than the intraday high. Now, if the price is able to break out early this week, maybe anticipating good numbers for the CPI and PPI later on in the week, Wednesday, Thursday, then all is forgiven and the uptrend remains in play. And this is not only on the daily chart, but the uptrend, if we get about 4,600, also becomes once again confirmed on the weekly chart. So all these things could be very, very important. And it starts with a break above approximately 44.75 on the S&Ps. However, if we break below 44.30 to the downside, then all that does is, again, we lose our 61.8% retracement, makes it statistically much more likely that we're going to revisit the lows over here. And this could be a very quick trip, especially if they're pushed by a hotter than expected CPI and PPI report. So I think we've got, by the end of this week, I think we're going to know whether or not we're going to be continuing with this uptrend or maybe starting the reversal process to the downside, maybe to an intermediate low here of 4,300 to 4,200, somewhere in this zone. I think predictions are a dime a dozen. I don't think they're really worth anything. So what I would prefer that you do is set up these decision boxes instead. And if your levels get hit, then it confirms one direction or the other. All right, guys, that's it for this weekend's report. Thanks for listening. We'll see you in the next one.